Hi everybody. I hope you're having a great time learning about accounts receivable. Well, now we're going to move on to the next thing we need to know, and that's allowances. So this is Class 25 Part A if you're in Monday, Wednesday, Friday, and Class 18 Part A if you're in Tuesday, Thursday. So we are moving on with Chapter 8, and we're talking about the allowance method. So in the last video, we talked about what happens if one of your accounts receivable doesn't repay you. Well, you write it off. There's two methods, the direct method and what we're going to talk about now, the allowance method. All right, so let's talk about the allowance method. In order to be in accordance with generally accepted accounting principles, GAAP, companies must account for their uncollectible accounts using the allowance method. The allowance method is based on the matching principle. Thus, the key concept is to record bad debt expense in the same period as the sales revenue. The allowance method is a method of accounting for uncollectible receivables in which the company estimates bad debt expenses instead of waiting to see which customers the company will not collect from. To do this, we will rely on past experience and our understanding of the axiom that the older accounts receivable are, the less likely it is that we will actually collect them. The offset to the expense is a contra asset account called allowance for bad debts or allowance for doubtful accounts. The allowance for bad debts is a contra account related to accounts receivable that holds the estimated amount of uncollectible accounts. The allowance reduces the asset accounts receivable. The net realizable value is the net value a company expects to collect from its accounts receivable. Net realizable value is accounts receivable less allowance for bad debts. So, we don't know who's not going to pay us back, but if we're matching the expense to the revenue, we have to estimate what that expense is going to be. So let's say in a month we have $1 million in sales, and a lot of that's account receivable, maybe all of it. Maybe it's $1 million in revenue and $1 million accounts receivable. So obviously some of that's not going to get paid back, so that creates that bad debt expense that we were doing in direct write-offs. However, for a big public company, we have to use the matching principle, which means I have to write off some of that bad debt right now, but I don't know who's not going to pay me. So I just set up an allowance account, this contra account. And then later, when I figure out, oh, who went bankrupt, who's not paying me, then I'll just take it out of there. So this allows us to net out our receivables, right? That word net we've been using all along means you're going to subtract something out. So we're going to take account receivables minus allowance for doubtful accounts, or allowance for bad debts, we'll call it in this book, allowance for bad debts. And then we'll get our net realizable receivables, and we'll put that on the balance sheet. All right, so net receivables is what we're trying to get at using this allowance method. All right, so what we usually do is we do this at the end of the period. We set up our allowance for the next period, right? So basically, we're going to expense at this period. So the end of the year has come along. We've had so much revenue and so many receivables, and we're going, okay, well, but really, we need to stick our expense in this period, so we need to set up that allowance. So here's how you do it. You go, well, we think maybe about $80 worth is not going to be paid off. So you go bad debt expense, allowance for bad debts. And there you're done. See how we didn't write anything off? Remember on direct write-off it was bad debt expense, accounts receivable Jones, or something like that. We haven't written anybody off yet because we don't know who's not going to pay. We're just setting it up. So bad debt expense, debit, because expenses are always debits, and allowance for bad debts, credit, because it's a contra asset. It's going to reduce the asset accounts receivable, so it's a credit. All right, so now we've set up our allowance, and now there's some money sitting out there in the allowance account, and we've increased our expense account, and everything's all good. All right, so what will happen now is on the balance sheet, this is just the portion for accounts receivable. All right, so you know on the balance sheet there'd be current assets, plant assets, liabilities, right? This is just the receivables part. And of course cash would be before receivables. So this is just that. So on the balance sheet when you have this allowance, you put down your accounts receivable, then you put down less allowance for bad debts, and then you write your net realizable value out next to that. Sort of like we did the book value for plant assets when we did the building less accumulated depreciation building, and then we wrote the book value, right? That accumulated depreciation is another kind of contra account. Well, here this is that contra account. It lets us net out the receivables. So that's what, so our balance sheet's going to change a little bit. All right. Accounts receivable will be reported on the balance sheet, but it will now be shown at the net realizable value. The balance sheet now reports the amount of accounts receivable that Smart Touch Learning expects to collect, $43.20. The contra account, allowance for bad debt, is subtracted from accounts receivable, showing that the $4,400 is owed Smart Touch Learning. The company estimates $80 of accounts receivable will be uncollectible. So at some point you will find out who's not going to pay you back. You'll call them and they won't answer the phone, or maybe you'll get a bankruptcy notice from their lawyer. Something will happen, you go, oh, they are not going to pay me. Now you're going to write them off. You've already set the allowance up, so now you're just going to write off. Now you know who it is. When using the allowance method, companies still write off accounts receivable that are uncollectible. However, instead of recording a debit to bad debt expense, which is done when using direct write-off, the company will record a debit to allowance for bad debts. Bad debt expense is not debited when a company writes off an account receivable when using the allowance method, because the company has already recorded the bad debt expense as an adjusting entry. So on December 31st, we made that expense and the allowance, right? So now it's just sitting out there. Then say in January, February, somebody doesn't pay us. Now we're going to write them off. But we don't use bad debt expense anymore because we already accounted for the expense. We're just going to write off the receivable. All right, so here's what you do. Here's our example. On January 10, Smart Touch Learning determines that it cannot collect a total of $25 from its customer, Sean Clark. All right, so here's the journal entry. So now it's like, okay, now we need to record this because we know Sean is not going to pay us, right? So Smart Touch Learning, allowance for bad debt account is debited $25. So here's allowance for bad debts, $25. Accounts receivable, so here's the write-off part. Accounts receivable Clark, $25 credit. So we've written off the specific account now. All right, but we don't have to go back and do the expense part because that's it. So we're done. So we set up the allowance at the end of the year. We didn't know who it was going to be. Set up the allowance and the expense. Now we just write them off. All right. So one time at the end of the year or the end of the month or however often you do it, you set up your allowance. Then each and every time you write one off, you write it off to the allowance for bad debts and the accounts receivable. All right, so it's again the same thing. If you have to put it back on the books, Occasionally, a customer will decide to pay us even after the account has been written off. This requires 2 entries. First entry will reverse the earlier write-off. Second entry will receive the cash against the reinstated account receivable. So you remember we did this with direct write-offs. So here you go. So Sean says, oh hey, I got my 25 bucks. I'm going to go ahead and pay that. So we have to reinstate it, right? So you just flip. Just flipping that, putting it back on the books. Account receivable, debit 25, allowance for bad debts, credit 25. Cash received, debit, accounts receivable paid off, credit. So that's all we do, is we put it back on, then accept the payment. That's pretty much it. You're probably wondering to yourself, well, how do you know how much to set up the allowance at the end of the year, right? So if you just set it up once at the end of the year, how do you know how much? Well, companies use their past experience as well as consider the economy, the industry they operate in, and other variables. In short, they make an educated guess called an estimate. There are 3 basic ways to estimate uncollectibles: percent of sales, percent of receivables, and aging of receivables. Now, we will not actually be calculating this. For this class, you will be given the dollar amount of the allowance. So typically there's some person in the accounting department who says, okay, we've had this much receivables. Usually each year about 2% go bad, so they just make an estimate. It's not exact, it's not perfect, but it's just an estimate. But for this class, I really want you to focus on the journal entries and getting those right, and not so much estimating the amount. So don't worry about it, I'll just tell you. The allowance for doubtful accounts needs to be $1,000, and we'll just do it that way. Alright, so this is where we're going to stop the video. So now you know how to do all you need to know for setting up an allowance, writing off the account, and reinstating the account. Next video, we're going to talk about notes receivable.